your conference night? Yeah.
Now, our next speaker is already present at my side, Lee Sheppard. Your lecture, which is entitled Corporate Tax Planning and Avoidance. Ms. Sheppard.
Okay, so we have the diagram here, and we're gonna stare at this until everyone understands it today. This is the value-free part of the program, because I am going to talk about what the existing international consensus is and how the countries that you people represent can defend yourselves against, the structural problems. And I am going to speak as though you were advising your own governments what to do. Now, when we look at this, I'm going to go through my points here, and then I'm going to go back into detail. One big point is that, as nice as it sounds to have country-by-country reporting and transparency, it's not going to get you where you need to be. I mean, we have in the U.S. system, in our transfer pricing enforcement, which has become kind of a charade, we have a lot of transparency. This is a simplified diagram done by our Joint Committee on Taxation of a real company. This is not all of the companies. This is just enough companies to show how market countries are deprived of tax revenue. Transparency is not going to get you there because these, as Jack was saying, and the speaker before, and as Professor Christian was saying, these companies, this is not the laser pointer. Okay, this is the laser pointer. All right. These companies are just artificial. Oh no, what did I just do? Okay, these things. This is all just one big happy family. There's the U.S. parent there, okay? Everything else, except for the actual customers in the circles there, everything else is just a tax construct. It may or may not have employees. But, if you say, oh, well, better transfer pricing and country-by-country reporting is going to get me where I need to be with this thing, then you're just buying into the idea that these legal entities mean something. These legal entities don't mean anything. Financial accounting, and I have actually nice things to say about financial accounting. It's some of the best information we've got. Financial accounting looks at this and says, look, that's all one big company. We want your, whole numbers. Okay, next thing. Don't sign OECD model treaties. Don't sign UN model treaties. The OECD does not have the interests of small and medium-sized vulnerable countries. And notice that I am not talking about developing countries and developed countries. As far as these multinationals and their advisors are concerned, there is no differentiation. There are only countries from which there is extraction and countries where there are customers, and these are all countries from which income has got to be stripped. And the rubric that allows this is the international consensus. That's what it's called. It is the whole treaty network. The treaties protect multinationals primarily. That's all they were ever for, was to make life comfortable for multinationals. That's what tax treaties are for. Secondarily, the OECD protects the interests of the United States and the United Kingdom. Germany, okay? Germany is the biggest economy in Europe. It doesn't really even qualify to be listened to at the OECD. There's things that Germany wants to address this arrangement right here, this commission arrangement. They're not going to get them. because they're not a constituent. Now, if they're not a constituent, is Norway a constituent? I'm gonna get back to the treaty part. You want to, and this is it's almost an advantage of being on the smaller side. You want to enact specific defensive laws to address the problems that you know you have. If you have problems with, pricing of minerals going out of the country, or you have problems with ships being towed out into the ocean and sold, I can write you a 2-sentence statute that says, if you have an oil rig that's licensed to operate in Norwegian waters and operating there continuously, and it is sold while it's under contract, the sale took place in Norway, no matter where the actual sale took place. That's not a hard statute to draft. You can draft protective stuff and get it in your law, and they can't argue with it. Because right now, in some of these situations, the treaties are protecting them, and the countries that are harmed are not protecting themselves in their own laws. And speaking of protecting yourselves, for those of you who are from mineral exporting countries, for heaven's sakes, the agreements that you sign, this is the point of maximum leverage over the multinational companies that are extracting the minerals. They want the minerals, you have them. You can put the conditions in the agreements, you can put tax conditions in the agreements. As I understand it, and somebody correct me if I'm wrong, I am told that both sides of the North Sea, both the United Kingdom and Norway, signed production sharing agreements. You haven't been able to get a production sharing agreement from Saudi Arabia for 50 years. The country owns the minerals, the multinational gets paid to take them out, and then it buys them from the country at the world price, which is a very easy thing to find. And I think Brent is actually around here somewhere, right? We can sort of see it. Okay, so let's go right back through, why not to do these things? Why not to sign OECD treaties? I'm very grateful to Professor Christian, because she was talking about the norms. Well, where do we get the norms? The norms form what is called the international consensus. And the international consensus is basically a load of nonsense that protects multinationals. When you sign on to the international consensus, you sign on to a bunch of consequences that have very deleterious effects on what we call a source country. That's a market country. That's right around here. That's where this is Norway, and this is all of the countries that are represented in this room, right here where the limited risk distributor and the customer are, okay? When you sign an OECD model treaty, okay, you say there's no withholding or hardly any withholding on outflows of cash to multinationals. Now, why in hell do you want to sign that? India, South America, withhold. South America does not sign OECD model treaties because a treaty's a contract. They read the document. They don't like the terms. Okay, you sign on to respecting all these little boxes as real live corporations that decide their own actions and are separate economic actors, as Professor Christensen said. And as we know, these are not separate economic actors. On a balance sheet, these things don't exist. The transactions between them don't exist. But you sign on to not only recognizing the transactions between them, you sign on to recognizing and respecting the self-serving contracts that the multinationals' lawyers wrote to explain those little flows out of your country of cash on which there is no withholding. And you also sign on to a concept which we won't get into today unless somebody wants to ask about it later, called permanent establishment. And this is one the Indians are fighting to the wall. And next time you have one of these conferences, invite people from the Indian and Chinese governments, because they have signed a bunch of these treaties, and they are fighting this stuff. They are fighting for their own interpretations of this stuff, and they are fighting the permanent establishment concept, which is a rather nonsensical concept which says, well, if you multinational are operating in a country and are making money in a country, but you have any presence that is short of, a full-on automobile assembly plant, you are not taxable as in that country at the level of the owner of this plant. This thing has to be, a little circle drawn around it, and it cannot be taxed in a normal way. That is a pillar of that treaty. And it allows companies to, and we don't see it on this graph here, allows companies to, go in through the internet and sell services to everyone in the country and not pay tax. That's ridiculous. That's what permanent establishment has come to mean. You do not want to sign a document that's got that in it. Now, what do you do if you have these treaties? Norway has an awful lot of these treaties. Well, the European Commission, actually, the other day made some interesting suggestions because, the multinationals not paying any tax anywhere, including in most of Europe, has gotten so bad that, even the guys who are in charge of borderless Europe are starting to notice this. And they said, well, you shouldn't sign treaties with tax havens. And you shouldn't. The United States, by and large, does not sign treaties with tax havens. That's how the United States blacklists people. They, if you're really a tax haven in the eyes of the United States, there's no treaty with you. But they have a kind of narrow definition of tax haven because, one of the definitions, we heard this the other day, was, well, it's a small jurisdiction, and you have to be small to be a tax haven, because if you have real responsibilities to people and schools and roads and things like that, you kind of have to have taxes to finance all that. It's a jurisdiction that offers special deals to non-residents. Now that's kind of like Gibraltar. That's a very narrow definition. But you also, so you don't want to sign treaties with that, okay? But the other people you don't want to sign treaties with are the international enablers. The Netherlands, Switzerland, Bermuda, it qualifies as a tax haven in most people's eyes. Ireland. These are members of European organizations in good standing. They are low-tax jurisdictions. They have real tax systems. They tax their own people. But they also basically do a full-on business as conduits of money out of, they are not in themselves big markets, full-on business as conduits of money out of the market countries. That is all of your countries. When your countries are in the posture of consuming goods and services from big multinationals, all those American products and entertainment that you really want to keep your children away from, that's you're a market country for that stuff, okay? These are the conduits they use to get the income out of your country after your child has whined and pulled on your leg and you went and bought that product you didn't want to buy. You don't really want treaties with them, but these conduits have treaties with everybody, because you can't run yourself as a holding company jurisdiction without a treaty with everybody. You're beginning to see how treaties enable all this. But South America, Brazil is a huge country. The United States does a lot of business with Brazil. The United States has no tax treaty with Brazil. A lot of the orange juice in the United States it goes right into a boat that looks like one of those oil tankers, and it goes right up to the port in New Jersey. You can do business with a country without a tax treaty. As a country, you don't need one. You do need a bilateral investment treaty, which is a treaty that says that there has to be arbitration if there's an expropriation. You do need the rule of law. If you have enough oil, you don't really need either of those. But you don't need a tax treaty. Now, what do you do? What do you do if you've got treaties with the enablers? Okay? Well, you want switchover clauses. This country, Norway, signed a treaty with Ireland in the year 2000. It's clear what Ireland does. Ireland is one of the enablers. The enablers, and that's what these rulings that Professor Christian was talking about, they will defend the multinational's position in competent authority negotiations. That's a treaty negotiation between the two affected countries. They will defend it. That's part of the services they sell. There's nothing for them to defend if you have a switchover clause. The Norway-Ireland Treaty, somebody correct me if I'm wrong, but I looked at it, it does not have a switchover clause. Now, here's what that means. Norway is an exemption jurisdiction. That means foreign active income is exempt from taxation in Norway. Well, if the income has been shifted to Ireland and Ireland doesn't tax it, guess what? Ain't nobody taxes it. A switchover clause says that if the other party of the treaty doesn't tax the income, then the first party, that would be Norway in this case, gets to tax it. And the OECD model has in the draft a switchover clause that you can just pop into your document and say, guess what, we are not signing this treaty, or maybe, we want to open up a negotiation for a protocol to get this. But yeah, if you've got treaties with these folks, because your businesses will whine and they'll say, you have to have a treaty with Switzerland. Why? Well, because we need it for business. What business? Well, tax evasion, tax avoidance. Not really evasion, avoidance, but we need it for tax planning. I mean, look, that argument carries in the United States. The United States has treaties with Switzerland, the Netherlands, Luxembourg, all these European enablers, because our businesses, and that is what this is a graph of, our businesses want to be able to strip income out of Europe. Now, I don't know why Europe doesn't get a little peeved at us for having this policy, but that is what it says. So yeah, you gotta have switchover clauses. Now, all right, what are we doing here? Let's talk a little bit about laws, and then let's talk about the chart here, since we're having so much fun with it, and then we'll talk a little about the laws that you can put in place to protect yourselves a little from this. Now, I am very grateful to Professor Christian for setting up what is sort of point zero in this chart, because this is the U.S. parent here, okay? In Switzerland here, we see an intellectual property holding company. And the phase that Professor Christian was talking about was how that U.S. parent, I keep doing this, gets those intangibles into that Swiss intellectual property holding company. What the intangibles, the intellectual property, what that is, okay, that can be the patent on a valuable drug. That can be the trademark on that toy you bought your child. That can be a copyright on some movie you don't want your child to watch. That can be any kind of royalty-producing intangible asset. This is where the economic rents go. That is, if we're not talking about oil extraction, and we're not talking about mineral extraction, that is the key to the success of multinationals and the reason they make what the economists call excess rents. Because if you look at multinationals, there's not very many of them. And in some businesses, there's like one big company, or there's like 2 or 3 big companies. The reason they are successful, the reason they earn higher profits than a normal company is because they have these protected properties. Now, where the actual protection is going on in the United States, that's, but what is happening is, and this is what we saw in the Google case, and the thing about the Google case, and the thing about this case we're discussing here, U.S. law and practice permit this stuff. I mean, that Google plan that was discussed, that's pretty clean. Employees in Ireland? Yeah, there's people who don't have employees in Ireland. They've got letterboxes in Ireland. You know, this U.S. law permits everything I'm talking about here, everything Professor Christian was talking about, which means that you cannot, at the moment, look to the United States to get you out of this mess. You can't say, oh, heavens to Betsy, United States, your companies aren't paying taxes anywhere in the world. And they'll say, yes, that makes us more competitive. That's what they say. That's the whole discussion in the United States. Okay, but the key to the thing's income is this intellectual property. When this intellectual property, the rights to foreign use of it, are outside the United States, okay, then the income can be kept outside the United States. And that was a lot of what Professor Christian was talking about. That's not what I'm going to talk about. What we're going to do here is we're going to focus, if I stop turning the slide off, we're going to focus on over here where your countries are as the customers, and we're going to see how the money how the profits stay out of your country if this company here, this company is in this Bermuda thing, by the way. This could be a finance sub, and if it's a finance sub, that is completely a black hole of profits. We're assuming that this company uses this intellectual property in Switzerland to manufacture products here in China with the contract manufacturer, and then they get sold over here in Norway and the other countries represented in this room. Okay, now this plan up here, okay, this is, as our British friends would say, this is bog standard. This is every big American and British multinational has a setup like this for selling goods. Now, so what did we do here? Well, once we got the intellectual property in Switzerland, okay, then we made the product, right? That's our step one here. But notice that we didn't really, what's the sort of old-fashioned model? Well, manufacturer cranks out product. It costs $5 to make the thing, and then product gets sold to, a wholesaler for $50 and then gets sold to a retail customer for $100, right? This manufacturer, and this annoys the Chinese no end, this manufacturer doesn't make any profits. Why doesn't this manufacturer make any profits? Because this holding company in the Netherlands, and this is the holding company for all of Europe, because where there's this limited risk distributor here, and this commission agent, there'll be one in each country in Europe where this thing is operating. This holding company in Europe owns, and this is going to sound perverse and legalistic, and it is, instead of the contract manufacturer owning the raw materials out of which the stuff, whatever it is made, the principal company owns the raw materials. And the principal company sort of gives the raw materials to the contract manufacturer and pays it a little fee for manufacturing. This does not make the Chinese very happy. The Chinese will look at this and say, wait a minute, you sold that thing for $100, and our cost on that was $5, and you're telling us that this manufacturer makes $5 and, on this graph, $5.25. We don't think that's fair, and the Chinese will basically take the transfer pricing rules and argue with you about that. Now, the other thing that's happening is the Netherlands principal company, because now remember that it owns the product. It's paying royalties to the Swiss company for a license of that intellectual property, but it is not, and this is another little perverse part, it is not relicensing it to the contract manufacturer. Logically it should, but it doesn't, because it takes the position, well, since it owns the raw materials and the contract manufacturer is limited to a fee, it does not have to do a license there. So the income, really what we think of as the markup on a manufactured product, it is here in the Netherlands. But the Netherlands isn't seeing a lot of income either, and you probably have a ruling from them on this, because the principal company is paying a bunch of royalties to Switzerland, and you can shift a lot of income by paying royalties, and it's paying a lot of commissions to the commission agent. Now, it's shipping product off to a limited risk distributor here, and why have I got my arrows wrong? It's shipping product off to a limited risk distributor. No, actually, what is the limited risk distributor doing here? The limited risk distributor is getting paid for product, and it's going through the Netherlands principal. And this is another thing about the limited risk distributor. In the old days, and this country has fought a case on this one, on the distributors. The limited risk distributor is a commissionaire. And that means that it gets a tiny little markup for just moving a product that it does not own. It is what in English law would be called an undisclosed agent. Now, before it got reorganized or restructured, as the OECD says, because the OECD blesses this whole mess. This is called a supply chain restructuring, and the OECD wrote a big long paper saying, oh, heavens to Betsy, there's real business reasons for doing this. There are no business reasons for doing this. This is a tax setup. But before it got restructured, this little thing right here was a full-on distributor. It bought product from the manufacturer, and it resold product at a markup. And the markup, well, the markup got taxed here in Norway or in Germany or in some real country with a real market and a real tax system where it would have to pay real tax on that markup. So what the restructuring does is it limits the profits that are in this thing. And that means that all the markup on the manufacturing, remember our cost was tiny, it was $5 on $100. All the markup somehow winds up in the Netherlands, where it doesn't really get taxed, and then it will eventually, probably be lent to the Bermuda finance subsidiary to get it out of the country. But this thing is a little circle has been drawn around this to say that, oh no, it's not a distributor. It's not a real distributor, it's a commissionaire, and it's an undisclosed agent, and it only gets this little tiny fee. Now, Norway has gone into court on this one, and Norway lost, because on the same ground that France lost, that was under the commissionaire law. They said, well, it's described as a commissionaire, and heavens to Betsy, a commissionaire is limited to this little tiny profit, so therefore all it has is this little tiny profit, and there's no permanent establishment there. Well, Spain went into court with the same one, pretty much the same case as Norway, and they said, you know what? We understand that buying into the OECD model means that we have to respect those little self-serving contracts that were written between the principal company and the limited risk distributor. But we think that the limited risk distributor here, the commissionaire here, is not behaving according to the terms of the contract. And because it isn't, there should be a permanent establishment there of the parent, and more profit should be attributed to Spain. Now, what is that? That's a fight in court. And that's a difficult fight to have, because you have to march into court and you have to prove that this thing was not behaving according to the terms of its contract. And the Spanish have been doing that, and the Indians have been doing that. And we are going to see in the long run the breakdown of the permanent establishment limitation, and that is a good thing. But when you're talking about smaller countries that are less prepared to fight big taxpayers in court and are not just making a full-time business of fighting in court, then you really want to think about having other avenues of argument. You may want to think about taking commissionaire out of your law. The basis on which Norway lost the case was the commissionaire rules. What do you need those for? If you had English rules of agency and you said this thing is acting on behalf of its principal company and it's basically earning all the income right here in Norway that its principal company would have earned, you'd be in better shape in court. And that's the kind of thing, and this is my second point about enacting defensive laws. One of the things that the European Commission suggested, they said, well, you should have a general anti-abuse rule. Now, China has a general anti-abuse rule. The United States has one, but our IRS has said that they don't want to enforce it. India is going to put a general anti-abuse rule in its law. But those are very big countries with a lot of resources to expend on tax administration and fighting in court, because the general anti-abuse rule, and there's nothing wrong with them, but they are a ticket to a fight in court. And the reason for that is that they're flexible. They're supposed to cover everything. They say things like, well, if you did this purely for tax avoidance and it has no business purpose, we can unwind the transaction and we can tax you, okay? Now, I've just said 3 things there that have to be proven in court, all right? You have to prove tax avoidance purpose. You have to prove that you had no business purpose. And, this is not the burden on the tax administrator, but this is the pain in the ass in court. And you have to figure out what the unwind is. This is all very difficult in court. So if you're a smaller country with less resources to spend on tax administration, and you don't have a big, complex economy where there are going to be surprises. And what I'm saying here is, if you can sort of look at, what multinationals are doing in your country and say, I have a set of known problems here. I have the oil extraction. I have, this transfer pricing issue here that comes up over and over again. I have, this commissionaire issue. You might want to go for more targeted laws that solve your immediate problems. I mean, usually with a big country, we advise against that. We say, well, if you make a specific law, then they'll just run off and they'll get around that specific law. But in the case of a smaller jurisdiction, a specific law, when the same stuff is happening over and over again, is no bad thing. Because, you go at these guys with a general anti-abuse rule, and they will basically say, oh, heavens to Betsy, that law is vague. They'll say this to the judge. Judges are lawyers. Judges don't like vagueness. We can't know what the law really is because it's so vague. Oh, heavens to Betsy. Okay, how are we doing here? And then that also brings us to production contracts just for a second here. And that is, not production contracts. Don't sign production contracts, for God's sake. Because that's the point of maximum leverage over the multinational that was going to extract the minerals. There is a new line of thinking, and actually the IMF is working on this, that says put stuff in those deals. Put the tax stuff in those deals, sort of get the equivalent of an advanced pricing agreement in those deals. Get conditions that the mineral doesn't move out of the country unless taxes are paid in those deals. Do not sign deals that give the company ownership of the minerals as part of the deal. You want the country to own it and the company to just pay for it. If you're in a situation where, okay, you've got the production contract and the company already owns the minerals, then you want to have in your transfer pricing law a thing that says, look, when the first sale of this stuff is at the world price, which is a very easy thing to find, and it's actually consistent with the arm's length pricing nonsense. I mean, nobody can argue that's not an arm's length price, it's the world price. You also don't have to give them a gazillion deductions from that. And this is the hard part for smaller countries, and that is, do you really want to do things? If I'm dealing with the company and they've got the mineral and they're sending it out of the country, and you're saying, okay, world price for that, and they're saying, oh no, we have transportation costs and we have this cost and that cost, and first of all, you can challenge those costs. Second of all, you can write rules in your income tax law that say you don't have to have deductions for all those costs. I mean, an income tax does not mean unlimited expense deductions for every expense that a multinational can dream up. Like, there's loads of South American countries where management fees are just flat out non-deductible because every affiliate in their countries will pay management fees to the very distant parent who doesn't appear to be doing a whole lot of managing down there in Patagonia. It's just an excuse to move money out of the country, so you don't have to give them every cost. But what that points up is the fallacy of, and I actually am winding up here, so give me some props. The fallacy of going at these guys through a corporate income tax. And that is, yes, they're selling in your country. You want them to pay some taxes for the legal protections and the market they get in your country. Why does it have to be a corporate income tax? I mean, I've worked with the corporate income tax forever, okay? I'm really a 600-year-old vampire. That's why I'm dressed like this. and it's a lot of fun, but it is not the easiest tax for a smaller country to administer. The reason market countries have them, and big American companies have gone into countries and asked for them. They said to China, you have to have a corporate income tax, and the Chinese just looked at them and said, because we want the foreign tax credit for that. Oh, well, whatever, But it's a license to a big, long bunch of arguments with the companies. And it's expensive to administer. And there are other taxes that can be collected more easily, that you're not arguing with the OECD about jurisdiction with, like value-added taxes, and that, you don't get a foreign tax credit for it back in America, but there are other taxes that are easier to administer. So if you're in a situation where, it's like you've got a tax administration that's kind of not as much as you'd like, and you've got multinationals on the other side, and they're not paying, you might want to have a rethink and say, well, is there a tax that I can put in that I can collect with the resources that I have? And the answer to that is not usually going to be a corporate income tax, because it's a complicated and messy tax to collect. There's kind of a headline problem there. Multinationals pay no corporate tax, but they pay no corporate tax anyway, so you almost have nothing to lose sometimes. Okay, do I have anything? I think I am okay with this. All right, thank you.